Depreciation versus amortization, that's what we are going to see in this video. Let's start with an example for depreciation. Imagine there is a machinery purchased for 1.2 million, that is 12 lakhs, and its useful life is 5 years only. At the end of the 5th year, this machinery can be sold for 2 lakhs. It means you are spending 12 lakh now and you will get 2 lakh at the end of 5th year. So in effect, your investment is only 12 minus 2, 10 lakh. So this 10 lakh have to be apportioned over a period of 5 years, which is a useful life. So if you calculate 10 lakh divided by 5, what you get is 2 lakhs. This 2 lakhs can be treated as an expense and charged to the profit and loss statement every year in the name of depreciation, and this can be done for a period of 5 years. So in this way, this asset cost, that is depreciable amount, is taken to the income statement and profit is also calculated accordingly. So in this way, an item which is sitting only in the balance sheet is also rooted in income statement and its due effect is given on the profit computation. This treatment is very important because imagine instead of purchasing this machine, if you had hired this machine, you would have paid rental every year. Instead of paying rental every year, you have purchased it. So either way, the effect is same. In one way, you will be providing for expense, and in the other way, if you're going to say it is an asset, I'm not going to provide it as expense, then it is not a fair treatment. So it has to be provided, and that's why we have depreciation accounting. So depreciation is basically allocating the cost of tangible asset. Look, stress is on tangible asset. So we are going to allocate the cost of tangible asset over its useful life. So in our example, the cost is 10 lakhs, not 12 lakhs. 12 lakh was the original cost. We have deducted the salvage value of 2 lakhs. So 10 lakh is the cost that is going to be allocated. And what asset is this? It is a tangible asset, because I use the example of machinery. It's a tangible asset which you can touch and feel. And what is a useful life? Useful life is 5 years, which is based on the best estimate made by the management. And in this period, the cost is allocated in the name of depreciation. And why it should be done? It's because we are using the machine. If we are not going to provide for it, then it's not fair accounting. And the asset is also undergoing wear and tear. It can also result in obsolescence because of passage of time. So all this have to be provided for, and that's why depreciation is provided and charged to income statement as an expense. In certain cases, the asset which is being depreciated will also get revalued. That is, the value will be increased because of the changing market conditions. In those cases, depreciation will be provided even on the revalued amount. And whenever we estimate the residual value or salvage value, even in our case, we said 12 lakh is the original cost and 2 lakh is the salvage value, which is our assumption. But as per provisions, let's say following the Companies Act and all, it is given that the estimated salvage value should be within 5% of the original cost unless and until there is a proof available to differ from that. Let's say there is a documentary evidence which says that it can be sold for a price higher than this at the end of its useful life, then you can go with that. Otherwise, it should be within this range. And if some assets are going to have different parts with different useful life, then in those cases, what is known as component accounting comes into picture. It means it can be a single asset, but since different parts are having different life, they'll be depreciated separately. Okay, so we have understood some key elements related to depreciation, and now we'll jump to amortization. For understanding amortization, let's take this example of a patent where the value recorded in the balance sheet as asset is 5 lakhs. And let's say this patent has a validity only for 5 years, At the end of 5th year, you cannot sell it to anyone, so there is no salvage value. Now this 5 lakh is going to sit in balance sheet as an asset, but you are going to use this patent every year. So you have to charge it to income statement, P&L statement as an expense. On what basis you can charge? You can simply take the cost divided by its validity or useful life. So 5 lakh divided by 5 years, what you get is 1 lakh. This can be charged to income statement. So understand, amortization means you are allocating the cost of intangible asset. I think now you will appreciate the difference. Depreciation means allocating the cost of tangible asset. Amortization is on intangible assets over its useful life. In our example, intangible asset was patent, useful life is 5 years, and the cost is 5 lakhs. But in case of certain intangible assets, there will not be any definite useful life. Say for example, goodwill and all. In those cases, we will not have amortization. What will happen there is annual impairment testing. Every year impairment testing will be done, and accordingly impairment loss will be provided. Now let's tabulate the difference between these two. Depreciation is based on Ind AS 16, whereas amortization is based on Ind AS 38. Depreciation is provided on tangible assets, amortization on intangible assets. Depreciation calculation generally will involve salvage value. In amortization cases, mostly you will not see salvage value. For depreciation, we have 3 methods like straight line method, written down value method, and units of production method. For amortization, we have 2 methods, straight line method and units of production method. And useful life for depreciable assets are based on management's best estimate, whereas for amortization, it is actually based on expected useful life of that intangible asset, and if useful life cannot be established, then generally it will be considered like 10 years. So that's about difference between depreciation and amortization. If you like this video, do not forget to follow, comment and share. And here we go. Credit and Financial Analysis Mastery course. It's a comprehensive pre-recorded online course that comes with 15 modules of video lectures, basically 70 plus hours of video contents, multiple ebooks and reading materials related to credit and financial analysis that will make up another 30 plus hours of content. So totally it is 100 plus hours of learning resources. Then you will also get access to a private community in Telegram for clarifying your doubts in credit and financial domain. Then you also have the flexibility to choose 1-year subscription or lifetime subscription depending upon your learning goals. So by joining this course, you will learn basics of credit analysis, how to read balance sheet, financial ratio analysis, cash flow, fund flow analysis, how to arrive at credit risk rating, how to prepare CMA report, cash budget, how to assess credit facilities like CC, OD, LC, BG, term loan, how to write bank loan proposal, and you will also have access to case studies related to credit analysis. So to join this course, to know more about the course, comment CFA, and I'll share the details with you.